Your mortgage payment is not the whole housing crisis anymore. The new shock is the bill that arrives after the closing, after the inspection, after the moving truck, after the family has already pictured birthdays in the kitchen. Home insurance used to feel boring. Now it can decide whether a house is affordable, whether a sale closes, whether a retiree can stay, and whether a neighborhood quietly loses value. By the end, the problem will look less like a random price hike and more like a warning label on American housing. Most people still talk about housing as if the fight is only about mortgage rates and home prices. That is the old map. The new map has another line running through it. Can you insure the place, and can you keep insuring it next year? Insurance is supposed to be the calm part of owning a home. You pay into a pool. Most years, nothing happens. In a bad year, the pool helps you rebuild. That simple promise is getting harder to price, harder to sell, and harder for families to trust. The anger is easy to understand. A homeowner can make every payment, file no claim, keep the yard clean, fix the roof, and still open a renewal notice that feels like punishment for living in the wrong zip code. That is the emotional center of this crisis. You can do everything right as an individual and still get repriced because the whole area around you has become more expensive to insure. The official language sounds sterile. Risk-based pricing, catastrophe exposure, replacement cost, reinsurance, non-renewal, deductible structure. Those words are not wrong. They are just too clean for what happens at the kitchen table. At the kitchen table, it sounds like this. The mortgage was already tight, groceries are higher, the car insurance jumped, property taxes moved. And now the company that promised protection wants much more money or does not want the house at all. This is why home insurance is becoming the new housing crisis. Not because every insurer is evil, not because every homeowner is reckless, but because the math underneath homeownership is changing faster than families were prepared for. The old housing crisis was simple to see. Prices rose, rents rose, mortgage rates rose. The new crisis is sneakier because the home may look affordable on a listing site while the true monthly cost waits in the shadows. A house payment is not just principal and interest. It is taxes, insurance, maintenance, utilities, flood risk, roof age, local building costs, and sometimes a second policy that covers what the first one excludes. When insurance jumps, it does not feel like a luxury getting more expensive. It feels like a gate closing. Lenders usually require coverage. If you cannot get it, you may not get the mortgage. If you lose it, your servicer may buy coverage for you and send the bill. Force-placed insurance is one of the ugliest phrases in home finance. It usually protects the lender, not the homeowner, and it is often more expensive than a policy a homeowner could buy independently. So the homeowner is trapped between two systems. The bank says, keep coverage. The insurer says, this risk costs more or we are leaving. The family says, where exactly am I supposed to go? The Treasury Department's insurance office examined policy data from more than 330 insurers across more than 246 million policy records from 2018 through 2022. Its conclusion was blunt. Insurance is becoming more costly and harder to obtain for millions of Americans. That report found average homeowners' premiums rose 8.7% faster than inflation over that period. It also found households in the highest climate risk zip codes paid about 82% more than those in the lowest risk zip codes. The same analysis found non-renewal rates were about 80% higher in the highest risk zip codes than in the lowest risk zip codes. That matters because a price increase is painful, but a non-renewal can turn panic into paperwork overnight. None of this means every premium is fair. It means the pressure is real. Claims are bigger. Repairs cost more. Severe weather hits more expensive places. And the people paying the bill are not abstract market participants. They are homeowners. No AA has counted hundreds of billion-dollar weather and climate disasters in the United States since 1980, with a much higher annual pace in recent years than the long-term average. That does not prove any one premium is correct, but it explains why insurers have become nervous. The uncomfortable truth is that the country built a lot of wealth in places where beauty and risk often sit next to each other. Ocean views, forest edges, desert hills, wide-open storm country. The same features that sell the dream can raise the insurance bill. For years, cheap money and rising home values helped hide that tension. If your house kept appreciating, a higher insurance bill was annoying but survivable. Now affordability is stretched, and every extra bill lands harder. Home insurance is a strange product because people hate paying for it when nothing happens and desperately need it when everything happens. That makes the politics brutal. Everyone wants affordable premiums, but nobody wants an insurer that cannot pay claims. Insurers are not charities. They price risk, invest premiums, pay claims, pay staff, buy their own insurance, and answer to capital markets or policyholders. When they misprice the future, they can lose staggering amounts fast. But homeowners are not spreadsheets either. They are not able to instantly move because a model changed. They cannot rebuild local infrastructure. They cannot control global reinsurance markets. They cannot stop hail from hitting an entire subdivision. This mismatch is why the debate becomes so bitter. The insurer sees concentration of risk. The homeowner sees a family budget. The regulator sees political pressure. The lender sees collateral. The buyer sees a dream becoming conditional. Think about a grocery store for a second. A shopper can walk in planning to buy the same cereal, the same eggs, and the same coffee, but leave paying more because the package changed, the coupon moved, the loyalty price hid the real price, or the convenient option carried a silent premium. That grocery feeling is now spreading into housing. The advertised price is not the lived price. The sticker says one thing, but the final monthly reality includes details ordinary people do not see until they are already committed. Shrinkflation teaches the lesson perfectly. A box can look familiar while containing less. Insurance can feel familiar while covering less, excluding more, raising deductibles, or shifting roof damage from full replacement to depreciated value. Store layouts teach another lesson. The easiest choice is rarely arranged only for your benefit. End caps, checkout snacks, premium shelves, and delivery defaults all shape behavior. In insurance, the easiest renewal may also be the least examined contract in the household. Loyalty cards teach a third lesson. The discount can make people feel smart, while the store learns exactly what they buy, when they buy it, and how sensitive they are to price. In insurance, data is also power, and models can sort households with a precision that feels invisible from the outside. Private labels teach a fourth lesson. Cheaper does not always mean bad, and expensive does not always mean better. But the comparison is hard because packaging, size, ingredients, and promotions keep shifting. Insurance comparisons are harder because coverage language is even less intuitive. Coupons teach the final lesson. A small discount can distract from a bigger price structure. A lower premium can distract from a higher deductible, weaker roof coverage, missing flood protection, or a claims process that becomes painful only after damage happens. That is not a conspiracy. It is modern pricing. Companies in many industries know customers are tired, busy, and overloaded. The friction is part of the system. Confusion becomes a margin. With groceries, the consequence is a painful receipt. With home insurance, the consequence can be a failed closing, an escrow shortage, a forced sale, or a neighborhood where buyers start walking away. The biggest mistake is treating insurance like a side bill. It is now a core housing cost. In some places, it can change the monthly payment enough to knock a buyer out of qualification. Real estate listings rarely lead with insurance risk. A listing may show a beautiful kitchen, a low-maintenance yard, and a school district people want. It may not clearly show the roof age penalty, wildfire score, wind deductible, flood zone, or carrier appetite. That is how the crisis sneaks in. A buyer shops the visible price and discovers the invisible price late. The home is not just expensive to buy, it is expensive to defend from the future. Climate risk is only part of the story. It is a major part, but not the only one. Inflation in labor and materials matters. So do building codes, litigation, fraud concerns, roof replacement disputes, and the cost of reinsurance. Reinsurance is insurance for insurers. When a carrier has too much exposure to hurricanes, wildfires, hail, or other catastrophes, it buys protection from another market. If that protection gets more expensive, the cost tends to move down the chain. The homeowner may never hear the word reinsurance until the renewal jumps. But the bill can contain that global stress. A storm season, a wildfire year, or a broader reset in risk pricing can reach a suburban mailbox months later. Replacement cost is another quiet driver. If a fire destroys a house, the insurer is not replacing it at the price the owner paid years ago. It is paying for today's lumber, today's labor, today's permits, today's contractors, and today's demand surge after a disaster. After a major storm, everyone needs roofers, electricians, adjusters, debris removal, hotel rooms, rental homes, and building supplies at the same time. That rush can raise costs when people are least able to negotiate. So, when an insurer says premiums reflect rebuilding costs, that is not just corporate language. It can be true. But the truth still hurts, because wages did not rise in the same neat line as risk. Deductibles are also changing the felt reality. A policy may exist, but the homeowner's share of the first loss can be high enough to make a claim feel useless for smaller damage. In some coastal markets, wind and hurricane deductibles are often separate from the standard deductible. They may be written as a share of the insured value, not a simple flat amount. That difference can shock people after a storm. Flood insurance is another trapdoor. Most standard homeowners policies do not cover flood damage. Flood usually requires a separate policy, often through the National Flood Insurance Program or a private flood market. Many families learn this distinction only when water enters from outside. Water from a burst pipe and water from rising floodwater can be treated very differently. The damage looks wet either way, the contract does not. Now look at what happens to sellers. If buyers cannot get affordable coverage, demand can weaken. If demand weakens, prices can soften. If prices soften, local tax bases can feel pressure. The insurance bill becomes a housing market signal. This is the part that should worry everyone, even people in safer places. Insurance stress can spread through housing markets quietly. It can change where people move, which homes sell, how lenders underwrite, and how local governments budget. When coverage becomes scarce, state-backed or last resort programs often grow. They can be necessary safety valves, but they are not magic. Risk does not disappear because a public program takes the policy. California Fair Plan is the state's insurer of last resort for many properties that cannot find regular coverage. Its exposure has grown sharply in recent years, reaching hundreds of billions of dollars, which shows how much risk has migrated out of the ordinary market. The Fair Plan can help a homeowner avoid being completely uninsured, but it often provides more limited basic coverage than a standard policy. Many homeowners still need supplemental coverage, which can make the total bill feel like a maze. Citizens Property Insurance in Florida has played a similar last resort role. Its policy count surged during the state's market stress, then began falling as depopulation efforts moved many policies back to private insurers. That sounds like improvement, and in some ways it is. But Florida still shows the deeper lesson. A market can look healthier from the regulator's desk while homeowners remain exhausted by years of high bills, special deductibles, and complicated choices. Florida's insurance story is not just hurricanes. It also involved litigation costs, roofing disputes, insurer insolvencies, population growth in exposed areas, and expensive rebuilding. Reducing one pressure does not erase the whole burden. California's story is not just wildfires. It is also old regulation colliding with new catastrophe models, reinsurance costs, construction inflation, and the political challenge of allowing prices to rise without abandoning consumers. Louisiana's story is not just one storm. It is repeated hurricane pressure, carrier exits, premium strain, and a coastal economy where people need insurance but cannot always absorb the price. Texas, Colorado, Kentucky, Iowa, and other storm-exposed places have felt versions of the same pattern. Hail is not dramatic on a national map until it hits roofs by the thousands. One reason this crisis surprises people is that the danger is not always cinematic. It is not only a giant hurricane on television. It can be repeated hail, repeated wind, repeated smoke, repeated small disasters that add up. Insurance pricing hates repeated surprises. It also hates uncertainty. When old patterns stop predicting new losses, companies either charge more, restrict coverage, or pull back until they trust the numbers again. That is where catastrophe models enter the story. These models try to estimate future losses from fire, wind, storms, and other hazards. They are not crystal balls, but they shape whether a company wants your neighborhood. To the homeowner, this feels unfair because the model may price a community, not just a person. To the insurer, it feels necessary because disasters hit clusters, not isolated budgets. Risk pooling works best when losses are random and spread out. It struggles when too many homes in one region can be damaged at once. That is the problem with catastrophes. They attack the pool itself. If one kitchen pipe bursts, the pool can handle it. If a wildfire burns thousands of structures, the pool becomes a battlefield of capital, reserves, reinsurance, and regulatory approvals. The political temptation is to demand low premiums by law. That can help consumers for a while, but if rates stay far below expected losses, carriers may reduce new business, tighten underwriting, or leave. The opposite temptation is to let prices float with pure risk. That may attract capital, but it can make entire communities unaffordable. A technically accurate price can still be socially explosive. So the real question is not, should insurance be cheap or expensive? The real question is, who pays for the risk that past housing decisions created and future climate conditions may intensify? Homeowners want stability. Insurers want adequacy. Regulators want availability. Politicians want headlines that do not anger voters. Lenders want protected collateral. Developers want buyers. Every player wants the risk to land somewhere else. That is why the bill keeps moving. Sometimes it moves into premiums, sometimes into deductibles, sometimes into exclusions, sometimes into state programs, sometimes into disaster aid, sometimes into a homeowner's credit card after a denial. The phrase affordability crisis sounds too polite for what happens next. Families start cutting other spending. They delay repairs. They raise deductibles. They underinsure. They skip flood coverage. They hope the bad thing does not happen. This is how protection gaps grow. A home may be technically owned but financially exposed. The owner has a roof, a mortgage, and a policy, but not enough protection to recover from the event that actually happens. Underinsurance is especially dangerous because it stays invisible during normal life. The premium gets paid. The declarations page looks official. The homeowner feels covered. Then a disaster reveals the gap. Insurance contracts are full of ordinary words with legal meanings. Wind, flood, wear and tear, earth movement, ordinance or law, actual cash value, replacement cost, matching, exclusion, endorsement. These words can decide tens of thousands of dollars. The safest move is not to memorize every legal clause. It is to notice the big levers. What is covered, what is excluded, what deductible applies, and what has to happen before the insurer pays. Actual cash value means depreciation matters. Replacement cost means the policy may pay to replace damaged property without subtracting depreciation, subject to terms. That difference can be the difference between a repaired roof and a painful loan. Fannie Mae and Freddie Mac have allowed certain policies with actual cash value roof coverage under specified conditions, which may lower premiums but can shift more roof replacement risk to homeowners. That is a perfect example of cheaper today becoming riskier tomorrow. Lower premiums are not automatically bad. Many families need options. But a cheaper policy must be understood as a trade, not a gift. The question is, what risk moved from the company to the homeowner? That trade is familiar at the grocery store. The family size box may not be the old family size box. The sale tag may require buying more than you need. The delivery app may make the convenient basket cost more than the planned basket. Grocery stores know shoppers compare the shelf price more easily than the unit price. Insurance markets know homeowners compare premiums more easily than endorsements, deductibles, sublimits, exclusions, and claims reputation. Kroger can show shoppers loyalty prices that feel like savings, while the real comparison depends on the regular price, the unit price, and whether the customer would have bought the item without the promotion. That same psychology works whenever a headline number hides the structure underneath. Walmart can make private label choices feel like relief for stretched households, and often they are. But the broader lesson is that consumers trade brand familiarity for price, and in insurance, some homeowners may trade stronger coverage for any policy they can afford. Delivery apps add another layer. Fees, tips, markups, substitutions, and convenience can make people lose track of the true cost of a basket. In home ownership, escrow has a similar effect. The bill is blended, so the insurance shock may not be obvious until the payment resets. Official inflation language often misses that lived confusion. A government index can say a category rose modestly while a family says, "My normal life got much more expensive." Both can be true because real households buy specific items in specific places under specific constraints. The same is true with home insurance. A national average can look manageable while particular counties, coastal towns, wildfire zones, or hail corridors become brutally expensive. The Government Accountability Office reported that recent inflation-adjusted premium growth looked modest nationally, but parts of disaster-prone states saw much larger increases. That is the whole crisis in one sentence. Averages hide pain. Risk is local. Insurance is local. Weather is local. Building codes are local. Lawsuits are local. Fire protection is local. But homeowners usually discover that local math through a renewal notice. One house can pay more because of roof age, another because of distance to brush, another because of wind exposure, another because of prior claims, another because the carrier wants less concentration in that area. Concentration is a key word. An insurer may not hate your house. It may simply already have too many houses like yours in the same region, facing the same disaster at the same time. From the company's view, pulling back can protect solvency. From the homeowner's view, it feels like being abandoned after years of paying premiums. Both feelings can exist at once. State Farm stopped writing new homeowners policies in California in 2023 and later announced non-renewals affecting about 30,000 residential and related property policies, plus about 42,000 commercial apartment policies. The company cited sustainability and exposure concerns. Allstate had also paused new homeowners policies in California, reflecting a broader pullback by major carriers in markets where they argued pricing and risk had fallen out of balance. Farmers made changes to limit exposure in California as well, showing that this was not one company having one bad quarter. It was a signal that large carriers were rethinking where and how they would grow. When big carriers retreat, smaller or specialty carriers may step in. Sometimes that helps. Sometimes the coverage costs more. Sometimes the financial strength, claim service, or policy language deserves closer scrutiny. A buyer can stretch to afford the house, then face a new premium a year later. If the mortgage rate is fixed, the family may think the payment is stable. Escrow teaches them otherwise. Escrow shortages feel like betrayal because the homeowner did not choose a new house. The tax bill changed. The insurance bill changed. The monthly payment changed. The fixed mortgage did not feel fixed anymore. A serious buyer now needs to ask for insurance quotes early, not after falling in love. They need to ask about roof age, flood risk, wind deductibles, prior claims, required repairs, and whether the carrier is actively writing in that area. Sellers also need to prepare. A beautiful home with insurance problems may need documentation, mitigation records, roof permits, defensible space work, elevation certificates, or clear explanations before buyers get scared away. Mortgage lenders are watching too. If insurance becomes unavailable or unaffordable in a region, collateral risk rises. A house that cannot be insured easily is a harder asset to finance confidently. Investors are watching even more closely. Climate risk data, insurance availability, and local premium trends can affect long-term property values. The market is slowly learning to price what it used to ignore. A retired couple did not model reinsurance cycles when they bought near the coast. A young family did not calculate hail frequency when they chose a suburb. A teacher did not study wildfire catastrophe models before accepting a job in a mountain town. Yet the bill arrives anyway. That is why this feels like a breach of the American housing promise. People were told ownership meant stability. Now the ground under that stability keeps repricing. There is another uncomfortable truth. Government disaster aid can unintentionally blur risk. If people believe public money will arrive after catastrophe, they may underbuy insurance or rebuild in risky places. But aid is often limited, slow, and not a full replacement for coverage. Insurance is supposed to price risk before the disaster. Disaster aid often responds after the disaster. Those are very different systems, and relying on the second one can leave families exposed. Mitigation is the part of the story that deserves more attention. Stronger roofs, better shutters, defensible space, fire-resistant materials, elevation, drainage, and modern building codes can reduce losses. But mitigation has a fairness problem. The people who most need upgrades may be least able to pay up front. A discount after a costly retrofit does not help much if the family cannot afford the retrofit. That is where smarter policy could matter. Grants, low-interest loans, verified mitigation credits, better land use planning, and clearer risk disclosure can reduce losses instead of just arguing over who pays after losses occur. The conflict is that stronger construction can raise upfront costs in a market already short on affordable homes. Cheap building can create expensive losses later. Expensive building can block buyers now. There is no painless option. Stronger codes can feel expensive before a disaster, but weak codes can become far more expensive after one. The argument is not between cheap and costly. It is between paying upfront or paying unpredictably later. Local governments face the same trap. They want growth, permit revenue, and property tax base. But allowing development in exposed areas can create future insurance and disaster costs that homeowners inherit. Developers respond to demand. Buyers want views, space, and affordability. Insurers later price the physical risk. The bill for yesterday's land use optimism becomes tomorrow's premium. This is why blaming only one villain misses the structure. Insurers made choices. Regulators made choices. Builders made choices. Buyers made choices under incomplete information. Governments encouraged growth. Weather changed the stakes. Still, ordinary homeowners have the least power in the chain. They cannot diversify across thousands of houses. They cannot raise capital in global markets. They cannot negotiate with wildfire seasons. So, consumer protection matters. People need clear policy language, fair claims handling, honest disclosures, and renewal notices that do not bury life-changing changes in confusing pages. At the same time, fraudulent or inflated claims raise costs for everyone. Roofing scams, staged damage, and abusive litigation are not victimless. They become part of the premium pool. The serious position is not pro-insurer or anti-insurer. The serious position is pro-functioning market. A functioning market pays valid claims, prices risk honestly, protects consumers, and keeps coverage available. That sounds simple until the losses get too large. Then every principle collides. Affordable prices can threaten availability. Accurate prices can threaten affordability. Strict regulation can protect consumers or push carriers away. Loose regulation can attract capacity or crush households. This is why the home insurance crisis is really a housing policy crisis. It asks whether America can keep building, buying, financing, and protecting homes in places where risk is rising. It also asks whether we are willing to tell the truth before people buy. A cheap house in a high-risk area may not be cheap. A dream location may carry a permanent risk surcharge. A low premium may hide a high deductible. Imagine if every listing showed a realistic insurance range, flood requirement, wind deductible estimate, fire risk context, roof age impact, and whether major carriers are writing nearby. Some buyers would still buy, but fewer would be blindsided. One reason people miss these patterns is decision fatigue. Buying a home already involves loan documents, inspections, appraisals, moving costs, school decisions, repairs, and family pressure. Insurance becomes one more box to check. Companies understand fatigue. Grocery stores understand it. Delivery platforms understand it. Lenders understand it. Insurers understand it. The tired consumer is easier to steer. That does not mean every steering tactic is abusive. Convenience has value. Bundling has value. Renewal has value. But when the stakes are this high, convenience must not replace understanding. A fair system should make the risk visible before the sale, not after the renewal. It should reward proven mitigation, explain denials, and make the cheapest option honest about what it does not protect. The homeowner's first defense is not paranoia. It is questions. What is excluded? What deductible applies to wind or hail? Is the roof covered for replacement cost or actual cash value? Is flood separate? What mitigation discounts exist? The second defense is shopping before renewal, not after panic. Independent agents can sometimes compare carriers. State insurance departments can provide complaint data and consumer guides. Neighbors can share real experiences, but anecdotes should not replace policy review. Another defense is not filing tiny claims casually. Insurance is for meaningful losses, and claim history can affect options. That does not mean avoid valid claims. It means understand the trade-off before turning every repair into a claim. One more defense is knowing the house as a risk object, not just a home. Roof, wiring, plumbing, tree cover, drainage, slope, distance to water, distance to brush, local fire response, and building materials all matter. Some people will say this is just capitalism doing what capitalism does. Price the risk and move on. But housing is not a normal consumer good. When insurance fails, communities can hollow out. Other people will say government should cap prices and force coverage. But if the numbers do not work, forced coverage can create fragile markets that break later or shift costs to taxpayers. The path forward is harder than slogans. Build safer, price clearer, subsidize carefully, stop hiding risk, help people harden homes, stop encouraging reckless development, make policy language understandable, track availability before crisis hits. That also means accepting that some places may need a different future. Not every risk can be engineered away. Not every home can be insured at yesterday's price. That is a painful sentence, but avoiding it does not protect anyone. Managed retreat, buyouts, elevation, and land use changes are politically explosive because they touch identity and wealth. But after repeated disasters, the alternative may be endless rebuilding with higher premiums and deeper public costs. America is not prepared for that conversation. We prefer heroic recovery stories. We prefer ribbon cuttings after rebuilding. We prefer saying communities are resilient. Sometimes resilience becomes a polite word for asking people to absorb the same hit again. Real resilience would mean fewer families needing rescue in the first place. It would mean homes built for the risks they face. It would mean insurance that is available, understandable, and financially honest. The shelf price of homeownership used to be the mortgage. The unit price of homeownership is everything required to keep the home: taxes, insurance, repairs, utilities, risk, and time. Renters are not outside the story. Landlords insure buildings too. If apartment insurance rises, some of that pressure can move into rents, fees, deferred maintenance, or decisions not to build. Small landlords may feel this sharply. A duplex owner or small apartment owner cannot spread costs like a giant portfolio. Insurance can turn a modest rental into a stressed asset. Condo owners face another version. Master policy premiums can rise for the association, and the cost can appear through dues or special assessments. The owner may be shocked even if their personal policy looks unchanged. New construction faces its own problem. Builders need buyers who qualify, lenders who lend, and insurers who write. If insurance costs are uncertain, projects become harder to pencil. The cruel irony is that some lower-cost housing is located where land was cheaper, partly because risk was higher. As insurance reprices that risk, the affordability advantage shrinks. That is already changing migration math. Moving to a sunny, low-tax, coastal, or fast-growing state may still make sense. But the insurance line can erase part of the savings people expected. The best personal finance advice is now less romantic. Before you move for cheaper housing, price the insurance, the flood policy, the car insurance, the taxes, the utilities, and the disaster risk. The same applies to staying put. A homeowner should not wait for a cancellation notice to understand the market. Ask an agent what would make the home harder to insure. Ask what upgrades matter. Ask what documentation helps. Communities should do the same at scale. Fire breaks, drainage projects, code enforcement, roof standards, vegetation management, and flood planning are not just safety issues. They are insurance issues. And the truth is uncomfortable. The cost of risk was never zero. For a long time, it was hidden, averaged, delayed, subsidized, or underestimated. Now more of it is showing up on the bill. The fairest solution will need shared responsibility. Homeowners harden where they can. Insurers explain and pay fairly. Regulators balance price and availability. Governments stop approving obvious future losses. Lenders and real estate platforms disclose risk earlier. None of that gives instant relief to the family staring at a renewal notice tonight. For that family, the crisis is not theoretical. It is a number on paper that changes dinner table math. That machine includes storms, fires, construction crews, global capital, local law, roof age, flood maps, reinsurance contracts, claims behavior, political pressure, and consumer confusion. Once you see the machine, the phrase home insurance is the new housing crisis stops sounding dramatic. It sounds like a plain description of where affordability is moving next. So when someone says housing is cooling, ask what is happening to insurance. When someone says a market is affordable, ask whether buyers can get coverage. When someone says inflation is under control, ask what families are paying to protect the roof over their heads. Another takeaway is that the problem is not one villain. It is the collision of climate risk, rebuilding costs, regulation, development patterns, claims behavior, data models, and household budgets. One more takeaway is that communities can reduce risk, but not by pretending risk is fake. Safer building and clearer disclosure are not luxuries anymore. They are affordability tools. That does not mean homeownership is dead. It means the old shortcut is dead. You cannot judge a home by the listing price alone. You have to judge it by the full cost of keeping it safe. If this made you look at your own policy, your next renewal, or a home listing differently, that is the point. Like the video, share it with someone shopping for a house, and comment with this question: what is the biggest insurance shock you have seen in your area? This is not paperwork anymore. It is a housing survival skill, and people who learn it will make cleaner choices than people who discover it during a storm, a cancellation, or a closing week surprise for good.